Hello folks, LA here. This is weekly report for February 13th recording. It's for the 11th. Last week we saw some pressure primarily in the big caps. They sold down and the S&P went along with them. Small caps got a gain. The big thing was gold getting a push to the upside. This one might be turning, and we actually took a position in that sector. Year-to-date loss is pretty good. A lot of rolling bounces here in washed-out sectors, but they're only bounces at this point. Got a lot to cover, so let's just pop into it here technically, right? The big thing that I saw last week was the high and mighty getting sold, and a few down and outs still continuing to get some bids. And what I mean by that is, you got three sectors if you look at the last 3 years: XLK, XLC, and XLF. XLK, 129% gains over 3 years. XLC, 70. XLF, 65. These were all three of them, all 3 years, 2 of the 3 in the other 2. These sectors account for 51% of the S&P, and so if they're lagging, the S&P is going to lag as well as the NASDAQ index, and that's what we're seeing so far this year. The rotation too has been in the XLE. Last year got a big bump. So far this year, another big bump. It only accounts for 3% of the performance, so it's not going to help the indexes. The other rotations I'm seeing so far, they just appear to be bear market type rotations. And what I mean by that is you see this push down, push up, push down, right? And you stair step lower. And that's the kind of action we're seeing at this point. If we look at those three sectors and we ask ourselves, how are they doing? Are they breaking down? What are they doing? Well, the sneak preview here is one of them isn't, one is, and one's on the fence. XLK is on the fence. I'm going to let you look at the charts, but basically this one looks like it's going to try and go lower. How far could it go? About 20% if it were to really start to break down. XLC has already got a top in place. This one's got a rolling top. You got this stair stepping down that I was just talking about already taking place. Next target is down around 64. And if we look at the next targets on the monthly, even farther down. Should get a bounce here pretty soon though, because the bearish short-term time frame is very stretched. So I would be looking for some sort of a bounce. XLF is the strongest of the three. This one's still holding, but just like the others, you're seeing bearish retest regions end up failing. Bullish retest regions end up failing. This one just made a nominal new high again, but I suspect it's done. It's probably going to pull back. If it were to work its way lower, you could see it has about a 22% area that it could decline before it actually finds solid demand. And so in general, if you look across almost all sectors and the indexes, you're going to find that solid demand is another 15-20% down, even from here. And that's with 10% losses already. And so if you want to worry about something, that's what you worry about. Here's two more that are worth mentioning. The SOX I mentioned last week is a potential short. Turned out to be a good short, but we didn't actually get a position in it on that bounce. But this looks like a top is in place again. We've seen retest regions fell all along the way, and the latest one doing the same thing. I think this one probably has topped out 20%. If it goes all the way back to really good demand, that's almost 45% from here. ITB, I've seen all the talk about how bullish this sector is, with lumber prices what they are, etc. Well, if it is, then why isn't it doing something? Right? Well, we know it isn't because of interest rates and the cost of housing based on those interest rates. If this gets a major break here, it's going to target the 57 area probably. And like everything else, this thing has already failed on the bullish retest regions. If we look at the indexes real quick, I've got them on the daily. You got the push down, the push up, right? Now the roll. This is the congestion area. If it gets into that area and closes into there, you should expect it to get to the lows. If we look at the NASDAQ, it's already starting to get into that area. A little bit farther along, it will probably go after the lows, and I suspect they all will because the NDX already is. NDX is deep enough at this point. Anything more, this thing's going to go after the lows. Small cap's the worst of them all, so it has all of this congestion. Anybody bought this thing in the last year has lost money. And so anybody coming up, when price comes up, anybody that's in there is going to try to sell to get back out. And so you have a huge supply overhead that's going to contain prices for some time. And if you look at the Russell, you can see just how bad it is. Vis-a-vis the performance of the Russell versus the S&P, 25% worse case, worse performance. That hasn't happened since 1999, and we, of course, know what happened in 1999. Everything went to hell. One other note here is that you're getting a large number of zombie firms growing as interest rates go up, and it's going to just continue. I don't think it's going to stop because there's a lot of debt out there, and they're not going to be able to service it with the sales and profits that they're making. On the fundamental side, CPI printed. It was even stronger than we expected. The rates were flying higher until all of a sudden Ukraine war talk hit the news wires on Friday, and then the market pushed lower very quickly, whereas rates reversed and went down as there was a flight to quality. Next week, I suspect that's going to be temporary. Once this is all done, rates are going to start doing what they were doing before, probably. But there's time, like everything else, it's timing. They're going to come back, and then eventually they're going to continue their trend, which is higher. Next week, it's the last big week for earnings. You got the revision of the GDP second. Probably doesn't matter. The two things to watch are the PCE, which is inflation barometer here in the States, and the European CPI, which is inflation barometer in Europe. Hawkish ECB now makes this much more important than it has been. Got a holiday in a week, so that will make a 3-day weekend, and if the Ukraine situation is still heating up by then, that may become important. So the bottom line here is you got three sectors driving this S&P, 51% of what drives it. One of them's on the fence, one of them's down and out, and the other one is trying its best to hold. That doesn't bode well. If we look at this market and we think about it continuing lower, at the beginning what happens is you get stair-stepping. And so you can see that stair-stepping, where you go down, you come back up like I was explaining earlier. The problem is when this does this enough in the distribution that has taken place, maybe, this whole area becomes the distribution. When that takes place, right, what's next? It's markdown. And markdown is where they just sell it without any question, without any real bids underneath it. And that's the real risk. If you think about it, you've got all this heavy weighted stocks in these ETFs, all kinds of ETFs. If they start selling the heavily weighted stocks in mass, everything's going to go down because all those ETFs are going to have to sell on the way down. And so that, to me, is the biggest risk that's out there, and something that eventually is probably going to drive this market to its lows. Current selling is driven by continued fear of higher interest rates and inflation. I think interest rates are probably a little overdone at this point. They hit their 2% on the 10-year. They're probably going to back off a bit and start it on Friday. The inflation numbers, they're going to actually see year-over-year comparison is going to get better in another month. And that's probably going to, make that a little bit more digestible, I should say. Assuming the worst case, right, if things just get worse, in other words, rates just keep going up, inflation numbers keep printing high, we've already seen on the preceding charts, you could go down another 20-30%. So that is a worst case scenario. But the more likely case, at least short term, is that we've probably gotten too far here, and that interest rates probably have topped out for a little bit on a short-term time frame, and that's going to give this market a pause and ability to try and jump higher. On the trading plan, pretty flat last week in terms of performance, despite having 70% of the portfolio invested, which, given the losses elsewhere, is a good thing. The landscape, the main thing I wanted to talk about here is this: the landscape has changed. When you're a trader, even an investor, if you're trading around the edges, there are different types of markets. There's markets that just go straight up, right? There's markets that thrash, right? And then there's markets that eventually just go down, right? Now, as we've seen, it's stair-stepping on the way down. And so when I look at these things, right, there's a different pattern that you trade here versus you trade there versus you trade here. And it's changed. It's no longer this, right? It's not the straight up stuff. It's the thrashing. And so you've got to be able to time your entries and flip with the market. And if you want to see what I'm talking about, look back at that last leverage trade to understand it. Basically, you got to take what the market gives you. When the market doesn't want to give you anything else, you got to take what you got and get out of the way. If you're, counter trend trading, essentially, and that's what we were doing, and that means that you can't hang around if the market starts to turn back in the direction of the trend. You got to stay flexible, and you got to do what you got to do. We added a gold trade last week. There's, the portfolio is fairly well positioned. Got a short in it, and some energy stocks. So this keeps it keeps our head above water, so to speak. Last week I talked about the chip sector. Didn't get a trade on there, but wanted to. It turned out to be a good trade had we had made it. Most likely scenario was the closest one last week. I'm not that optimistic about the coming week. You can see the numbers here. I think best case, you get back up into the swing point low. Worst case, you break the swing point low that's below us. And the more likely case is you get into all this congestion, maybe down towards the bottom of it. That's it for this week, folks. Have yourself a great one. Stay safe, and I'll see you next time.